Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. And what a day we had in the stock market on Monday. Thunderstrike across the AI sector within the markets. And what are the implications of what we saw? So what took place on Monday? We had some news about an AI company out of China and some of the new technology that they're developing at a small fraction of the cost of what these US titans are producing. And all of a sudden we were seeing some of the biggest names in the US stock market, names that have been celebrated for the last many months, falling by as much as 20% in a single trading day. That's some 1987 stock market crash type of stuff. So what should we take away from this, and what is the implications of the declines that we saw? Well, the first thing to mention that's important is we need to keep these declines in context. While the tech sector really took a hit on Monday, the rest of the market held up just fine. The NASDAQ was down over 3%, but the Dow Jones Industrial Average, which is a broader measure of market performance, was actually up a little bit less than 1% on Monday. So that's a good sign. The selling was isolated, and the other thing about it is that yes, these stocks declined a lot, but they declined after rising so much in the weeks leading up to the decline. So while a stock like Nvidia fell by 17%, it's back to levels that it was trading at in October. Broadcom's another one, fell by 17% as well on Monday, yet it's still 10% higher from where it was a month ago. So while these declines look dramatic in isolation, in the broader context, they're nothing more than a pullback as part of what's been an extraordinary run for these stocks over the last few years. Now, none of this is to say that we don't have to worry about the downside risks associated with these stocks going forward. The most important thing to note, these stocks have done tremendously well for several years, and as a result, they are now trading at extremely expensive valuations. And when stocks are trading at these types of rich premiums, these are the types of declines that you can see on a daily basis like we saw on Monday. We have seen these episodes take place in the past as well. If we go back to the turn of the millennium with the dotcom bubble, there were some fantastic companies that are still around today, but once the valuation dam broke and the correction started, the pullback lasted for a few years. Same thing with the biotech sector. A decade ago, people were talking about the biotech revolution and how these stocks could go higher regardless of valuation. And that was all true until we hit September 2015, when some benign news, similar to what we heard on Monday, sent biotech stocks falling by over 20% over 6 trading days. As we sit here a decade later, those stocks are effectively back to the levels that they were trading at in 2015. It's been a long washout period. Now, I'm not saying the same thing is going to happen to the AI stocks this time around, but it's something that we need to be cautious about. They've had a tremendous run, and this is a pretty violent pullback. That doesn't mean that we rush in. We need to do our analysis and maintain our discipline when making investment decisions. And more broadly, it's important, as we always have, to stick with the long-term discipline. Maintain exposure to these areas of the market that are doing so well, but also be broadly diversified. There's a reason why we own sectors across the market, because healthcare and consumer staples, they were up over 2% on Monday when all the bloodletting was taking place in tech. That's why we diversify. When one area is going down, another area is going up, and we get a much smoother returns experience over time in working to achieve our long-term goals. Thanks for joining me for this latest Market Insight, and I look forward to seeing you again soon.